I'm Scarlet. This is ETF IQ, where we focus on the access, risks, and rewards offered by exchange-traded funds. Caution ahead. Investors may be signaling a lack of faith in the stock market. They're pouring money into low volatility funds. Where active stands tall, PIMCO's David Braun shows it's possible to buck the trend toward low-cost passive funds with his bond ETF. And betting on Brexit or not. Either way, there's an ETF for that, and we show you how it's performing as the talks drag on. Love them or hate them, ETFs are here to stay, and their flows are often a bigger tell on market trends. So that means it's time for Eric Balchunas to show us what he sees in the flows.
Thank you, Scarlett. You mentioned earlier, look, investors are feeling a little defensive, a little into safe havens. Been the third straight week of a negative performance in the S&P, starting to weigh on investors. Showing up in the flows here. IBV in the inflows, that is a good sign, obviously. But look at XLP. This is never this high. This is the Staples ETF, right? And it looked 760 million is a lot. But look at the year it's having. That would be a record if it ended now. So a lot of money into Staples, despite the market's performance. But again, most of the market's performance was the first 3 months of the year. Last 6 months, market's barely up. And look, we've got our two poster children of the year, with mine. GOVT for fixed income, that's the whole curve at once. That's been on a tear this year for fixed income. And USMV on the equity side, that's minimum vol. That's how people want their equities this year, is a little less edge. Let's look at the outflows, and this case gets stronger. It's a who's who of trading crowd favorites, risk-on ETFs here. Little mini bloodbath, actually. So SPY, the Qs, IWM, JNK, I mean, everybody's on there. VU is the outlier. VU seeing 2.7 billion in outflows is highly unusual. I don't think this is mom and pop running for the hills. I think it's a model trade. We'll see. Maybe I'm wrong. Speaking of that, let's look at traders and allocators. That chart I love to show to see what's going on. Now, good news is allocators are hanging tough. They are still putting in money despite the VU outflows. The traders, though, are spooked. And you can tell it's one of the worst weeks for outflows from those ETFs. So, Scarlett, I think this is one of those cases where defense has become the place where the best performing ETFs are. So performance, chasing, and defense are not one and the same this year.
Yeah, and of course it's showing up in momentum as well. All right, let's bring in Sam Husko. He's founder of SGH Wealth Management, and Vildana Heinrich. She is a cross-asset reporter for Bloomberg News. Sam, let me start with you. Eric just gave us his take. I'm curious to get a sense of what you're seeing. Any themes, distinct themes that are showing up in the market as the fourth quarter gets underway?
Yeah, absolutely. I mean, the low volatility factor has been getting all these flows over the course of the year. And, the big question with that is, are these performance chasers? Are they going to come in and out like momentum, which we are seeing a bleed between the momentum factor and the low volatility factor today? And so, with that, you got to dive in. And I would say on a short-term basis, this could potentially be an anomaly. But on a long-term basis, I think there is good reasons to continue with a low vol factor. And one good thing to distinguish here as well, too, is the difference between low volatility and minimum volatility. The sector constraints is the bigger thing within that. And when you look into the low volatility sectors, utilities are at a 24% overweight over the last rebalance. And then also real estate is at a 16% overweight as well, too. And so, with that, they've had really good years because interest rates went down almost a little unexpectedly. So within that probably won't persist. But within the long-term trends, there's really good reasons to still be in low volatility.
And Vildana, you have some numbers to share with us when it comes to low vol, the money moving into these low vol funds.
Right. These two products, USMV, SPLV, are among the most popular low vol products, and both are on pace to see record inflows for the year. USMV alone has taken in about $12 billion so far this year.
So let's talk, you read your top 5 ETFs here, and 2 of them are mid-cap low vol and small-cap low vol, which is interesting. How are you using those? Is that your full mid-cap and small-cap exposure for your clients? Because this is one of the critiques, is you're going to be, in the Invesco brand, you're going to be a little overweighted with some of those sectors, although a lower PE. So just talk a little bit about how you use those in a portfolio.
Yeah, well, first off, it is our 100% exposure to those. So we are willing to be active managers. We believe, min vol, those same metrics I was saying before, 24% in utilities, 16% in real estate. Min vol only has about 5% and 2%. So they're much closer to the index. And so we believe, there's going to be small elements of active management that can be, returned out of that, but nothing major. And so, that said, what we want to look at is how to kind of seize that. And the low vol on the long term, it's about dispersion of performance. So in an uptick, in the best performing months in the market, dispersion is fairly tight. So the best performing stock and worst performing stock are fairly close. So when this thing underperforms, there's a lower price to underperformance because we're going to do pretty close to what the markets do. But in that downturn, dispersion gets really wide. And so in those moments, this has, in the worst performing months in the market, this outperforms 86% of the time in those worst performing months. So, with that, it goes down about 60% of what the markets go down by. So really, you make your money in that downturn,
right,
even though the markets might recover at a smaller pace.
Vildan, I want to turn to you because another big theme that's come up of late, of course, is Brexit. There's been lots of talk, but no action and therefore no clarity. How is this showing up in ETF trading?
Right, and it's a bit counterintuitive because there is so much happening Brexit-wise, and we have the UK economy slowing. But if we take a look at a fund like EWU, it's been seeing inflows over the last couple days. And then if we take a look at BlackRock's FTSE 100 fund, which is listed in London, it's also been seeing inflows. It had its best month ever in September, and a lot of people might be looking to short, but at the same time, we do have investors who are betting that the fallout from Brexit won't be as bad as a lot of people are expecting.
Of course, you got to balance that. And of course, within the asset management industry, you also have the fee wars, the race to zero.
Yeah, and Sam, I got to ask you this. We talked earlier. You're a Schwab client.
Correct.
Schwab went to zero. They caused everybody to go to zero except for Fidelity. But you're starting to hear more rumblings. These other platforms are upset that because Schwab won't give you much in your cash sweeps, 0.12%, and that's how they make their money, and they feel like it's kind of misleading.
Sure.
You're a client. What do you think of that in terms of that sweep yield you get, which is pretty low, as you can see here, compared to the other ones?
Yeah, I mean, what I think about that is if I was keeping a lot of my clients' money in cash, I'd be getting a lot of phone calls. So, they're not giving me their assets to sit in a cash money market. And then, as we discussed earlier too, you can still buy a money market that's outside of their sweep. So I don't really see it as an issue. What I do see in Fidelity's approach to this, at least, and that's, I think, the biggest news item out of this is, they didn't make as much of their money off of, other vehicles. And so they have to kind of keep their profit margins to where they are, which they are very profitable, private company. But then also they make a ton of money on 401ks. So we got to understand where their bread is buttered. Those don't have transactional fees. And so it's a different model altogether.
Sam Husko, fantastic insight. Thank you so much.
Thank you.
Sam is with SGH Wealth Management, and we also want to thank Bloomberg's Vildana Hyrick. Now coming up, a conversation with David Braun, who manages the PIMCO Active Bond ETF. He takes us inside the bond giant's move into ETFs. And one fund that caught our attention this week, the iShares Short Maturity Bond ETF, ticker NEAR. With investors anticipating a Fed rate cut later this month, the $6.3 billion fund saw its fifth straight day of outflows, the most since its 2013 inception. And of course, you can find that chart and all the others that we feature on Bloomberg at GTV Go. This is ETF IQ. I'm Scarlet Food. This is ETF IQ. Let's take you through the ETF Lifecycle, which has three main stages. Step one is always the filing, a pair of funds that'll invest according to Sharia law guidelines. Watch for the SP Fund's Dow Jones Global Sukuk ETF. It'll buy Sharia-compliant financial certificates known as kubuks. The second fund will target S&P 500 companies, but exclude those in certain sub-industries. Step two is the launch. The Barclays iPath Gold and Silver ETNs begin trading this week under the aptly named tickers GBUG and SBUG. A key point is they will track their metals futures market, not the physical asset. The kicker here is the cost. Both products will have an expense ratio of 0. And for some, the final stage is liquidation. The Direction Daily 7 to 10 year Treasury Bear one-time shares is folding after 8 years. TYNS is an inverse trading vehicle on the ICE 7 to 10 U.S. Treasury Index that never had much in the way of assets. Time to get passive aggressive now, where we track the shots fired in the battle between active and passive investing. And ETFs are usually a tough nut for mutual fund companies to crack, but PIMCO, the bond giant, got into the ETF business early, and it's paid off. Its assets are now north of $20 billion in ETFs. So who better to discuss this than David Braun, who manages the PIMCO Active Bond ETF, better known by its ticker BOND. Great to see you, David.
Thank you for having me, Scarlet.
So with all the volatility in equities, fixed income clearly is in favor, and fixed income ETFs are on track for a record year of inflows. And this will be the first year in 10 that fixed income takes in more funds than equities. As an active bond manager, how significant is this?
Yeah, so as you mentioned, we were early to the ETF bandwagon, right? 10 years ago, we launched the first actively managed fixed income ETF, and we felt the ETF vehicle would be a great place for us to deliver our fixed income strategies to investors. And as you point out, first time in 10 years, fixed income flows are trending higher than equity flows in ETF. We think that's great. I think a couple reasons why that exists. One, you look at the volatility in the equity markets in the fourth quarter of last year, it really woke investors up to the fact that you need bonds in your portfolio as insurance against equity risk. Second, there's been a renewed fear in the market on where global growth is heading, right? We've been talking about this for a while. And in a lower growth environment with greater volatility, bonds are a key part of one's portfolio. And then on the active side, because that's the topic of the show, if you look at the trend there, not only is fixed income growing faster than equities, but active fixed income is gaining a larger part of the pie, right? 2-3 years ago, it was only 5%, now it's almost 10%. So PIMCO is happy about the growth in fixed income in ETFs and happy about the growth in market share for active fixed incomes.
But when you look at the flows into fixed income ETFs, a good chunk of that is going into funds that track the AG, which is your benchmark. Eric likes to call the AG the Washington Generals of benchmarks because it's so easy to beat, you know, compared to the Harlem Globetrotters. And the numbers certainly back it up. Now, if that is the case, why are investors buying these funds that are tied to the AG index, like BND, like AGG?
Yeah, so I mentioned how 10% is active, and we're happy about the rate of growth of that, but still 90% is passive, right? And they're trying to replicate an index like the AG, as you mentioned, right? So we believe in ETFs, the move into passive fixed income has been largely inadvertent. If you think about it, ETFs came into their own as a vehicle for equity funds. And in equity funds, a lot of investors believe that it's hard to beat the passive benchmark, so therefore go passive. So then when fixed income started to grow in the ETF channel, it was almost a knee-jerk reaction. It was like, oh, it's an ETF, I want bond exposure, I should get passive. You look at mutual funds, only 25% or thereabouts are passive versus the 90% in ETFs. And as you mentioned, that the indices are flawed, and there's some structural reasons why they're flawed. The one example I like to give investors is the indices are debt-weighted. So you, by definition, buy more bonds for the most indebted issuers. I always use the analogy for people to keep it simple, that if you owned a bank, and imagine someone came into your bank and said, I want to get a loan from you. And your first criteria and your only criteria was really, well, how many loans do you have outstanding already? And if they said a lot, you give them a big loan. If they say none, you give them no loan. We try to do the opposite at PIMCO, where we're lending to people for more important reasons than that.
No, when we talk about the AG as a benchmark, it's pretty vanilla and it's pretty easy to beat. Do you think we'll get to a point where we'll get more sophisticated benchmarks that are be used to measure bond managers, active bond managers, and fixed income ETFs against? Near Kesar writes about this, talking about a great bond index apocalypse coming for these managers.
Yeah, I saw that. I think what people are getting at with that discussion is smart beta, right? So we can all agree that the indices are flawed, so let's use some smart beta or factoring approaches to create better indices. And we would certainly agree with that, and we're certainly looking at strategies there. But the thing I'd caution people on is a lot of these smart beta strategies simply just lever up beta. And what we as an active manager are trying to deliver is alpha, not beta. And the most notable beta people always lever up is credit beta, right? And if you look at history, if you own credit through multiple decades, you're going to cultivate most of that spread above and beyond the credit losses you incur. The problem we have with that strategy is by just being systematically overweight credit in all markets, once a cycle, you drive your customer's car into the brick wall at full speed, and you incur massive credit losses. Now, we don't profess to be perfect at timing cycles, but we think we have to try to get the clients out of harm's way. And when you see froth in the market and low spreads and high leverage, it's better to de-risk and not just add more beta. So again, we're trying to add alpha and not beta.
Right.
I think a lot of these sampling methods are just adding more beta.
Big distinction there. Speaking of distinctions, there are some big differences between bond and AG, specifically the mortgage holdings and treasury holdings. Could that change? Talk a little bit about that.
Yeah, so what we're trying to do in bond, and we try to do this in all of our portfolio, Scarlet, is deliver a more diversified basket of bonds, right? So indices are pretty generic. They stick to pretty generic asset classes. And diversification is powerful because it's a tool where you can actually cut your risk a little bit. You can cut your risk by diversifying your bets across the broader part of the market. And you can also add upside return because you're buying less trampled over assets than the generic stuff that's in indices. So in bond, what we're trying to do is be very cautious on corporates. And I don't know if you popped it up, but we have roughly benchmark weight in corporates, but the devil's fully in the detail.
Yes.
We're double the weight in financials because we think bank balance sheets look pretty darn strong, and we're underweight non-financials. And in mortgage space, we have a lot of non-agency mortgages and asset-backed securities in there.
All right, David Braun of PIMCO, thank you so much for joining us today.
Thank you for having me.
Now coming up, as the UK and EU seek some kind of breakthrough in their stalled Brexit talks, we take a look inside the $2 billion UK iShares ETF. This is ETF IQ. I'm Scarlet Food. This is ETF IQ. Now, for every ETF that offers exposure to a sector or to a theme, others are quick to follow suit. If you're seeking growth, technology, and disruption, so is everyone else. WisdomTree has packaged it all into one fund, and Jeremy Schwartz is here to tell us more about it. Before we get to him, though, Eric Balchunas is here to give us the drill down into the firm's Modern Tech Platforms Fund.
Thank you, Scarlet. Yes, Platt. This is the tracks tech, obviously, as it says, modern platforms, digital marketplaces. So it tracks things like Twitter, eBay, but also the London Stock Exchange. So anything people are sort of moving across on the internet on. You're going to be overweight tech and communications, obviously. Let's look at the tail of the tape here. These aren't the best products to compare it to, but if you look something like ARC or FDN, you can see some similarities there. I think the non-US exposure here, you get more international in this one. And you're going to have the similar market cap weighted. So it's like one of these, but it's very different as well. Now, I want to introduce this new function, Drive Go, which just came out, which is perfect to use on this. It goes next level and shows you other things that the ETF is exposed to. So, for example, the stocks in this ETF are very much have positive sales surprises. That's a tailwind. That's good, obviously. A lot of cash, a lot of ROE, but you're going to be a lot of dispersion on what sell side thinks. That's a headwind. A lot of volatility. And the dividends, you get no dividends here. So this is going to show you the different ways to look at the ETF. So, but beyond that, as we all know, what's really going to jumpstart this is whether it performs well or not.
Of course, it always comes back to that. Now, still with us is Jeremy Schwartz, Global Head of Research at WisdomTree. So, Jeremy, when I looked at the fund and what it contained, it seems like it was e-commerce, e-payments with some exchanges thrown in there for good measure?
I mean, it is really trying to be, if you think about how is business transforming, you hear a lot about this asset light where you don't own the production, you own the means of connection. And when you think about, as you guys gave in the lead, growth, how do you find growth? And all the smart beta factors that focus on value, and even WisdomTree got to start focusing on value. And we're saying, how do we get more growth exposure? Is there a business model that's changing the industry? And these platform models from Uber and Lyft and these asset light seems to be a growth story that you can get around. And they're growing earnings and sales. Like the sales is 3 to 4 times faster than the standard S&P 500 companies. And their margins, whereas the standard margin, gross margins are 30% on S&P 500 company, these are in the 60s. So there's a really good business case that this is the future of a lot of business and that these are growing faster with better margins.
Still, it's a pretty distinct theme, and WisdomTree is not exactly a firm that's known to be a thematic ETF issuer. They have Platt, they also have one that deals with cloud computing.
You have cloud computing. I can see a trend here. Now let's talk about this because you come from the academic world and you know quants and academics, they kind of look down on themes. They think they're gimmicky. Here you are coming out with them. Defend the value of a theme ETF.
And I go back to going beyond value. And so, you know, if you say growth, like how can you get at growth in different ways? In the tech space, software is a lot of the future of tech, and this cloud is really what's going after software. And so it was a unique opportunity to partner with Bessemer Venture Partners. They were creating an index. They're the premier venture capital firm focusing on the cloud space. They worked with NASDAQ Traded Index. We licensed that index. And you know, going beyond value, if there is this big long-term shift towards the cloud, we think that's just another great way to get exposure.
All right, let's go away from themes for a moment and go to geographies, because you're known for your Japan funds, specifically DXJ, which is your Japan hedged fund. What's the case for DXJ right now?
So a lot of people focus on the central banks and monetary policy.
Because they're a big owner of the ETF.
Look at that chart.
That's the big narrative, and it's that all the way around the world, from the ECB, the U.S. I just wrote a piece that Japan is the world's deepest value play. Now, they have dividend yields ahead of MSCI EFA. If you go back 30 years, they've had a lower dividend than the broad international markets, much lower than the S&P. The dividends and buybacks have been increasing. So DXJ's average dividend yield is 3.5%. That's 50% more than the S&P 500. They're doing buybacks. So everybody says Japanification, we're worried about Japanification of the global economy. Japan is Americanizing. They're getting the buyback and dividend trend, the shareholder returns at lower multiples than most of the international markets.
Yeah, but isn't that taking all the animal spirits and the reality out of the market?
They're trying to support, and this is like, are the central banks chasing their own tail, where they started buying it to lower the equity risk premium, the market's safe, we're buying equities, and now they have to worry that, well, now people worry they can't exit. How are they going to exit? We have a head of Japan, Jesper Kohl, who's talked about, well, if they just announced at the Ministry of Finance that they'll let people have an inheritance tax free to buy ETFs from the Bank of Japan, they would be able to sell those ETFs in a minute. And so now you have this battle between the Ministry of Finance and the Bank of Japan. They have to figure out, are they just going to hold these forever? How do they get people comfortable that it's not this overhang on the market? Mm-hmm. But they did it to support the equities, and now just people are worried about it.
So very quickly here, do you even think about the BOJ when you're looking at Japanese companies?
I think they should worry more about the fundamentals, that dividend yield, higher shareholder returns, cheapest valuations in the developed world. And yes, the Bank of Japan is supportive, but so is other central banks.
All right. Jeremy Schwartz of WisdomTree with the latest on Japan and their new ETF plat. Now, we like to say that the ETF industry has something for everyone. Brexit fatigue is a real thing. And as we get closer to that October 31st deadline, there's an ETF to bet on UK stock moves. The iShares MSCI United Kingdom ETF, better known by its ticker EWU, offers exposure to UK large caps. Anyone interested in this fund needs to stomach the many headlines swirling around Brexit negotiations. Uncertainty over exactly how and when the UK leaves the European Union hasn't hurt EWU's performance as much as you might think. The fund has a positive return since the 2016 Brexit vote, mainly because of the benefits from the weak pound. But look for a cap on future performance. According to an OECD forecast, a no-deal Brexit would slice almost 3% from UK economic growth over the next 3 years. EWU's roughly 105 holdings are market cap weighted. The biggest industries represented are oil and gas, banks, and pharmaceuticals. Top names include HSBC, BP, Shell, AstraZeneca, and Diageo. EWU is one of the bigger single-country ETFs at more than $2 billion in assets. Its expense ratio is 48 basis points. Since launching in 1996, the fund has returned some 200%, trailing the FTSE 100 over that time. EWU gets a green light in the Bloomberg Intelligence traffic light system. And this is a single-country ETF we cite a lot.
Yes, single country ETFs are used by the trading crowd to play geopolitics. So watch for this thing to start to see volume and flows over the next couple of weeks.
That does it for ETF IQ. Be sure to catch us next Wednesday. This is Bloomberg.